Hey everybody, thanks for tuning in again. It has been a while since I uploaded the video, but going forward the plan is to release a video once every 2 weeks. I decided to start with the videos again because I realized that my due diligence is better when I prepare for a video and not just look into companies for myself. So therefore I will be releasing a video once every 2 weeks, or at least that's the goal that I set for myself. Today I will be discussing Crowdstrike, a company that is active in the cybersecurity space. They had the IPO mid-2019 and had an impressive growth in the previous few years. We'll have a look at Crowdstrike's latest earnings report, which they released this month. I'll give them a score using my scorecard, and finally we'll have a look at the valuation. Let's start with some background information. And nowadays the internet is the most common medium for interactions between corporations and consumers. With businesses intertwining their processes with an online world, breaches not only pose a risk to their infrastructure and technology, but also to the people that use them. And there is an ever-increasing need for companies to create technology and services that help protect our digital world from the risk of security breaches. Crowdstrike provides technology that primarily protects enterprise endpoints, with additional modules aiming at shielding companies' cloud workloads. They do this by the so-called Falcon platform, which also explains their cool logo. Or at least, I think it's a pretty cool logo. Before diving deeper, let me first explain what an endpoint is. Now, put simply, an endpoint is any piece of hardware that connects to a network. For example, connecting your laptop to your workplace network. These devices will then interact with the edge. The edge is the intermediary point that facilitates interactions between the endpoint device and either the cloud or physical database hardware. In general, the more endpoints that enter the trusted perimeter of a corporation, the more data that is sensitive ends up being stored on endpoints. Dus the more capable the endpoint protection must be. Now, malicious actors could get access to the company's highly sensitive infrastructure by gaining access to an endpoint. The most common technique to either compromise or exploit an endpoint device is malware, and there are 8 common forms of malware. You have adware, unwanted spam-like and malicious advertising, which leads to additional malware being downloaded by the user. I think you all are familiar with that one online. Then there's fileless malware, malware that doesn't use executable files to infect devices. A virus, malware that attaches to files, executes only when said file is launched. There's a worm, malware that replicates itself and spreads from device to device throughout the network. A Trojan, a program that appears to be legitimate, but is in fact malicious and is able to spread similarly to a virus or worm. Bots, malware that performs an automated task without requiring any interaction. Ransomware, malware that encrypts a device data and holds that data until ransom is paid. And finally, there is spyware, which is malware that infiltrates a device and monitors the activities of the associated user. At the core of Crowdstrike is its AI-enabled threat graph. It is the brain of its Falcon platform, and this is what sets it apart from all of its competitors, especially those that provide on-prem security solutions. Now, how it works is that it collects threat incidents and stores them all in the cloud. As more data is collected, the threat graph gets smarter by the instant, providing visibility and real-time protection for all customers. The capability demonstrates clear network effect mode because as the threat graph gets smarter for more data, its ability to protect customers also increases. Now, it would be good to also have a better understanding on the number of organizations that are impacted by cyber attacks. In 2020, approximately 68% of organizations have experienced one or more endpoint attacks that successfully compromised data or their IT infrastructure. Now, delving deeper, ransomware, one of the most commonly used forms of malware as just mentioned, have been used in cyber attacks affecting 47% of small to medium businesses and 54% of larger organizations. 46% of all cyber breaches impact businesses with fewer than 1,000 employees. This is according to Verizon's 2021 Data Breach Investigations report. For one thing, these attacks are unlikely to attract the media and law enforcement attention that attacks on large companies might. 61% of SMBs were the target of a cyber attack in 2021. And not all of these attacks achieved their aim. However, the high percentage of targeted businesses show how commonly attackers single out SMBs. 82% of ransomware attacks in 2021 were against companies with fewer than 1,000 employees. And furthermore, 37% of companies hit by ransomware had fewer than 100 employees. This is believed to be a result from a shift in tactics of cybercriminals that leverage ransomware. Attackers are turning away from mega-sized targets to focus on small and mid-sized companies, because the funds they receive from a number of such attacks can easily add up what they receive from a large enterprise. And since SMBs tend to be easier to breach due to weaker security measures, it may take less time and effort to accomplish an attack. Now, endpoint breaches are not only increasing in frequency, but also becoming more destructive to resources as well. In 2020 alone, there were over 700,000 attacks against small businesses, totaling 2.8 billion in damages. 95% of cybersecurity incidents at SMBs cost between 826 and 653,000. The long tail cost of a data breach can extend from months to years and include significant expenses that companies are not aware of or do not anticipate in their planning. Now, these costs include lost data, business disruption, revenue losses from system downtime, notification costs, or even damage to a brand reputation. In the visual shown here, we outline the impacts a business may face from the first year up to the third year. Now, consequences of cybersecurity incident may still impact your business weeks, if not months later. I think there was enough background information for now, so let's focus more on Crowdstrike itself. First, the total addressable market, the TAM, which is represented as 76.1 billion in 2023 and is expected to grow at a 2-year compound annual growth rate of 30% and reach 97.8 billion by 2025. The TAM for Crowdstrike could even increase to 158 billion by 2026 if they increase their project offering, and which is what Crowdstrike is planning to do. Now, the global cybersecurity market was valued at $218 billion in 2021 and is expected to reach 550 billion by 2029, registering at a compound annual growth rate of 12.3% during the forecast period of 2002 and 2029. According to McKinsey, the most prestigious consulting firm in the world, the TAM could even increase to 1.5 and even $2 trillion. Now, regardless of whether these estimates will be 100% accurate or not, it is clear that there is a great opportunity for Crowdstrike ahead. I mean, if you look at the numbers, current TAM of Crowdstrike being 76.1 billion, and here we're talking about 550 to 1.5, even $2 trillion. It's exciting to see where this industry as a whole is going to lead to. Let's focus on how Crowdstrike makes its money. Crowdstrike's business model is straightforward and easy to digest. They make money in two main ways: the sale of subscription plans to customers, as well from the professional services business segment. Crowdstrike offers customers access to 5 pricing tiers. You have Falcon Go, Falcon Pro, Falcon Enterprise, Falcon Elite, and Falcon Complete. Each of these components' base price and model access can be seen here, with customers then having the option to add additional functionalities to the platform to their plan as they go along their cybersecurity journey. Now, professional services revenue is derived to either hourly rate of fixed contracts, retainer agreements, or one-time arrangement for services ranging from forensic and malware analysis, consulting services, and incident response management. In essence, professional services make revenue from enterprises that desire to benefit from Crowdstrike human capital and the related functionality that comes with that. Now, before moving on, I think it's important that you understand the general functionality of Crowdstrike's sales tactic. Now, similar to many other SaaS companies, Crowdstrike leverages what is known as a land and expand sales strategy. In essence, Crowdstrike's primarily objective is to continually have a stream of new customers knocking at the door, or which then can be converted into customers that use a few models, which then can be converted into valuable customers that use 5+ models. In addition, the existence of companies' professional service business segment complements the strategy quite nicely, existing as a means for Crowdstrike to latch on to a customer with the provision of these services, aiming to eventually convert them into a source of recurring subscription revenue. So basically, those teams also function as marketing or sales teams, and I think it's a great strategy to make potential customers familiar with your product and show them at the same time your expertise, and then try to convert them into valuable customers. Let's have a look at Crowdstrike's latest earnings report and guidance. Here you can see that Crowdstrike has a broken book year, so they don't report by the end of December like most companies, but they report by the end of January. In Q4, they managed to get a total revenue of 637 million, which is a 48% increase compared to last year's 431 million. And year over year, this year they managed to get 2.24 billion compared to 1.45 billion last year, which is even a 55% year over year increase. If you look at the Q4s of the last couple of years, we can see that in their book year 2020, Q4, they managed to get 152 million revenue. This year, they managed the 637.4 million, which is a compound annual growth rate of 61.3%, which is really impressive. It's crazy high. Year over year, they managed the 48% we just mentioned, and quarter over quarter, so for the Q3 to now the Q4, even that is close to 10%. If you had a look at the clients in Q4 2020, they had close to 5,500 clients. Now they're above 23,000 clients. I mean, also that's a compound annual growth rate of 61.8%. Really impressive. If you had to look at the other metrics, we have annual recurring revenue, even quarter over quarter, that's still close to 10%. Client growth, 8-9% each quarter. And if you look here at the amount of clients that have 5 plus, 6 plus, or 7 plus module, you can see that it started in Q1 23, they started with offering a new module. Immediately 90% of the clients take that, and it is growing quarter over quarter, all of them. So that means that all of the existing customers, they keep adding modules during their cybersecurity journey, which also is greatly reflected in here in the annual recurring revenue. So if you see that in the first quarter of 2018, or in their book year 2018 at least, they managed to get 71 million revenue. Now 6 years later, we're talking about 2.56 billion revenue, and still growing with 48% year over year, the quarter. It's really impressive. So including with the TAM we discussed before, I'm really curious to see where this is going in the future with this company. Now, as I mentioned here, the strong revenue growth, strong customer retention and expansion, dollar-based retention rate for subscription annual recurring revenue. See that the benchmark they set themselves is 120%, which they managed to get for the last 5 years, and the last couple of quarters they are around the 125% retention rates. So great numbers. The power of the platform, the percent of subscription customers with multiple cloud model subscriptions. So we also saw that in the table that we just looked at. 62% of clients have 5 or more modules, 39% have 6 or more, and even 22% have 7 or more models. You have here the attractive unit economics for the rule of 40. The rule of 40 is a principle that states a software company combined revenue growth rate and profit margin should equal or exceed 40%. And SaaS companies above 40% are generating profit at a rate that is sustainable, whereas companies below 40% may face cash flow or liquidity issues. We see here the strong gross margins, although a little bit declining. The downward trend in gross margin is related to continued data center investments and temporary M&A drag. And the operating income more than doubled in calendar 2020 as a whole, while Crowdstrike reached its long-term free cash flow margin target of 30% plus for the 3rd straight year. Let's have a look at some of the highlights from the latest earnings call. For guidance dimension, for the first quarter of full year 24, we expect total revenue to be in the range of 674.9 to 678.2 million, reflecting a year-over-year growth rate of 38 to 39%, with subscription revenue being the dominant driver of growth. They also mention we expect diluted non-GAAP net income per share to be in the range of 50 to 51 cents, utilizing a weighted average share count of 241 million shares on a diluted basis. Now, 2 things that are most interesting here. So first, the growth rate, 38 to 39%. It's a little bit lower than the previous years, but the law of large numbers, and still 38 to 39%. Very impressive. I think the most interesting here is the weighted average share count of 241 million shares. In the latest report, Q4, they mentioned 235 million shares, and now in the first quarter is going to be 241 million shares. So there's an increase in 6 million shares, and I think it's good to be aware of it as an investor about the dilution of your shares. For the full fiscal year of 2004, they mentioned we currently expect total revenue to be in the range of 2.95 billion to 3.01 billion, reflecting a growth rate of 32% to 35% over the prior fiscal year. Utilizing 243 million weighted average shares on a diluted basis, we expect non-GAAP net income per share to be in the range of $2.21 to $2.39. So for the people who are a big fan of earnings per share, that's around a earnings per share ratio of 55. I would say that's quite steep. And the other thing they mention is the growth rate for the entire year, 32 to 35%. Again, it's lower than the previous years, but it's still very impressive for a company this size. And the total amount of shares they mentioned, 243, it's still an increase from the 241 that they mentioned in the first quarter, but it's only going to be 2 million more added shares in the rest of the year. So it's still, I think the increase in shares is quite a lot, but it's less worrying than when I first read it for the first quarter. Other things that are nice to mention from the earnings call is that Crowdstrike now serves 556 of the global 2000 companies, 271 of the Fortune 500, and 15 of the top 20 US banks. Crowdstrike won its largest client this quarter for Microsoft Defender after they failed to protect the client in a multi-cloud environment. It turned to Crowdstrike incident response servers to more than double coverage while cutting costs by 50%. Now, Microsoft breaches in general continue to be a large lead generator for Crowdstrike, and for every $1 in incident response business, Crowdstrike enjoys more than $6 on average on upselling those customers to other modules. And leadership was asked multiple times if Microsoft was impacting Crowdstrike pricing power, but it was basically shut down, and they reminded us that most of the breaches Crowdstrike cleans up are directly the fault of Microsoft Defender. And a quote from the CEO George Kurtz, "Average spend for us remains consistent. Our shares gain tell us that Microsoft product is just not good enough." And that's not the first time that he goes after Microsoft software. There's quite a lot of interviews online with him attacking Microsoft and making sure that, attacking them and especially their software and saying stuff like, everyone wants to make sure that customers are protected, but Microsoft should focus on creating secure software. And also making a lot of comments about how they're more expensive, how you need more people in your company to deal with Microsoft software instead of the one with CrowdStrike. I mean, for me, it's fine if you make this comment, as long as clients go from Microsoft to CrowdStrike and not the other way around. Because at the moment that there's clients leaving from CrowdStrike to Microsoft, then basically all your words are just empty, and you should really just focus on your company and not so much on talking trash about your competitor. Now let's have a look on the stock price of CrowdStrike and how it performed in the last couple of years. So CrowdStrike went public in June 2019 at $34 per share, and it opened at $63.50 on the first day of trading. So almost already 100% gain on the first day. On March 16, during the whole COVID panic selling, the stock reached a low of $32.12, after which it basically started the bull run all the way to $295 in November 21, which is around 9x in a little over a year and a half. Not bad. And it dropped around 95, and I think currently the stock price is around 135. So if you have a look at some metrics, if you have a look at the price to sales ratio, so after the IPO, it was quickly around 60 to 70. During the March lows, it dropped all the way to 17, after which it went to 70 again, and currently it's around 14, which is still quite a high price to sales ratio, but I think for a company that grows as quick as the CrowdStrike does, there is something to say for this high valuation on price to sales ratio at least. You can have a look at the market cap divided by the free cash flow. Crowdstrike became cash flow positive by the end of 2019, but to be honest, this metric for now is not really useful because most of the cash flow, of the free cash flow for Crowdstrike is going to be in the future. So also seeing in the beginning when they became free cash flow positive, we're talking about 700 times the free cash flow to the market cap ratio dropping because the cash flow is increasing and also the stock price, of course, decreased during that time. And currently it is still at 44, but as I said, this is not really the right metric to value Crowdstrike right now. If you look at the total enterprise value divided by gross profit, I think that's more useful. The gross profit was already always quite high for Crowdstrike. So also now, since the IPO, that's been a good metric to value Crowdstrike. So during the IPO and shortly after, it went from 75 to 100. During COVID lows, it dropped all the way to 25. Again, up to 90. And now currently it is at 18, which I think is quite fair for a company that's growing as fast as Crowdstrike is doing. So now I think it's time to finally start scoring Crowdstrike using the Stockman Investing Scorecard. The scorecard consists of 5 sections. You have the management financials, the management culture, mode, the potential, and risk, which gives you a final score at the end. So first, the debt of Crowdstrike. Let's have a look at the total debt equity ratio, which is 52.7%, which will give them a score of 0. If you look at the total debt divided by EBITDA, which is negative 8.15, because Crowdstrike is still EBITDA negative. So for that one, we would give it the lowest score. But then if you look at the actual total debt of Crowdstrike, which is 783 million last year, has been quite stable for the last couple of years. And then have a look at the cash flow of Crowdstrike last year, which was more than 700 million. So I'm going to give them here the full point of 8, just because for me that's the total debt of around 800 million with a free cash flow of around 700 million. I think they're quite healthy and you should be able to pay it off quickly if you would like to. Also with their cash position of almost 2.5 billion. But feel free to use the debt to equity ratio and give them 0 points, or even for the negative EBITDA, you can give them even low points, but I'm going to give them 8. If you look at the current ratio of Crowdstrike is 1.73, so it's good, full points. The return on invested capital is negative 8.4% last year and has been negative in the last, 5 years. Now the return on invested capital is the net operating profit after tax divided by the invested capital. And since they're negative for the net operating profit after tax for the last couple of years, it also makes sense that their return on invested capital is negative. And it's mainly because of the high marketing cost of Crowdstrike. So you could say that if they would decide to lower the marketing costs, they would also be able to become return on capital positive, which would give it a different score. But for now, since it doesn't really look like there's going to be a change in the upcoming years, I'm going to give them the lowest score, -4. Now the direction of the return on invested capital is stable, 0 points. The free cash flow, as we just had a look at, is positive. They had 700 plus million this year, give them 2 points for that. The free cash flow percentage of EBITDA, now they're still EBITDA negative and a free cash flow of 700 million. So for this one, I'm going to give them 3 points. Then let's look at the CAPEX percentage of free cash flow. So the capital expenditure of Crowdstrike last year was 235 million. 235 million of 706 million free cash flow is in the range for 15 to 40%. So it's the 2 points. We give them a total of 14 points, which is not really great. It's mainly because of the return on invested capital is very low. I mean, I can see that definitely increasing in the upcoming years, but for now, I'm going to give them -4. And you could even argue that the 8 points that I gave them for the debt section should actually be 0, which would only give them 6 points in total for the financial section. So there's a lot to improve on this one. Let's continue with the management culture section. First, the CEO experience and the track record of the CEO. The CEO of Crowdstrike is George Kurtz, and he started his career at Pricewaterhouse as a CPA, and they made him one of the first employees in the new security group. In 1999, he wrote a book about cybersecurity for network administrators, and later that year he started his own cybersecurity company, Foundstone. Foundstone later got acquired by McAfee, and McAfee made him the general manager of risk management, and later they made him into the chief technology officer. Over time, Kurtz became frustrated that existing security technology functioned slowly and was not, as he perceived it, evolving at the pace of new threats. And the story goes that when he was on a flight, he saw a passenger next to him taking 15 minutes to McAfee software to load. And that was the moment he decided that he wanted to start his own company. He resigned from McAfee in October 2011 and started Crowdstrike in February 2012. In his personal life, he is an avid exotic car collector, and he's driven many sport cars, and he's also currently still driving in his own Crowdstrike racing team. Next to that, he's also sponsoring the Mercedes team for Formula One, and they also sponsor the safety car. For the safety car, I think it's clever because, the whole purpose of Crowdstrike is to provide safety. So I think it's a nice link between these two main interests. So for this one, if you look at the experience and the track record, he's the founder of the company, amazing track record, full points. I trust the CEO to act with integrity. Well, for now, I have no reason to believe otherwise. I looked at quite a lot of interviews from him, and I think he's very passionate about what he does, and he's very passionate about the cybersecurity in general. So I'm not going to deduct any points here, 0 points. Then the next one is very interesting. The CEO pay and compensation is reasonable and based on long-term success and the stock-based compensation. First here you can see that his compensation was 1.57 million. Now, that seems pretty okay. After diving a little bit deeper, I found that the base salary was 750,000, with the non-equity incentive plan compensation 815,000, which then the 1.5, 1.6 million that we saw before. But then here, value of stocks award, 146.1 million, which gives him a total compensation for the fiscal year ending in 2022 of 147.7 million, which is, well, absolutely ridiculous. And here it also mentioned that the CEO pay was 805 times more than the median employee's pay for the fiscal year ending in 2022. Having a look at the stock-based compensation trend for Crowdstrike in general, you can find it in the cash flow statement. So in the book year ending in 2020, it was around 80 million, 21, 150 million, 22, already 310 million, and last year 526.5 million. So this trend is definitely not positive, and also the amounts are absolutely ridiculous. And then I found something else quite interesting on this topic. The top paid members for Crowdstrike. On the fifth spot, there was Michael Carpenter, former president. He had a total compensation last year of 11.30 million. On the fourth spot, Colin Black, who's a former CEO who left in the meantime, but he still earned 10.72 million. Sean Henry, the president of Crowdstrike Services and chief security officer, 12 million. Then we have Bert Paulbert, the chief financial officer, almost 26 million, which is also already a lot of money, let's put it like this. And then on the first place, of course, George himself, almost 148 million. Now, they do mention here that it has to be earned by both performance and time-based metrics, but still 148 million. It's a lot of dilution for the shareholders. So for this one, I'm going to give him the -4. Skin in the game, percentage ownership. add a look at the SEC filing, and you can see here that George has 11.57 million shares. With the current stock price of around 130, it means that he has over 1.5 billion in value in shares currently. So I would definitely call that skin in the game. Get 6 points here. The management ratings. Let's have a look at the overall score, the CEO approval, and the people would recommend it to a friend. Go to Glassdoor for that. You can see that they're listed on one of the best places to work in 2023 on the 15th spot. They won Best Company Work-Life Balance in 2022, so that's quite impressive actually. And then here, 82% would recommend it to a friend. The CEO gets an approval of 89%, which is really high, and overall score of 4.3. So I'm giving that the full points for the management ratings, 7 points. Then have a look at the mission statement. Now also here on Glassdoor, they already mentioned something about the mission. It's way too long, but at the beginning at least. At Crowdstrike, we're on a mission to stop breaches. Okay. Let's have a look on Crowdstrike site itself. Here they mention our mission is to stop breaches and our purpose is our promise. Okay. And on the investor relationship, I found we are on a mission to protect our customers from breaches. So, okay, the focus breaches, but everywhere the mission statement is a little bit different. So I'm gonna deduct a point for that already. Is it simple? Stop breaches? Yeah, definitely simple. Is it inspirational? Not so much, to be honest. If you put the customer part in there, so the one that you found on the investor relationship page, we're on a mission to protect the customers from breaches. Okay, that one I think is inspirational. And also provide optionality. Yeah, I think it does provide optionality. For now, they only focus on endpoint security. There's, of course, a lot of different ways to provide security in the cyber industry. So giving them 3 points for this. Let's have a look at the insider buying and if there's any hedge funds or gurus that are buying Crowdstrike. Okay, we can see that Tiger Global Management has 1.16% of their portfolio in Crowdstrike. See that Viking Global Investors has a small position of 0.37% of their portfolio, but at least in their recent activity, they added a big amount of shares. So they added 146 shares. So it'll be good to see in the upcoming quarters if they're gonna continue increasing their position. And then for insider buying and selling, here it says transactions 70 sell transaction, 7 buy transaction. So it's mostly selling what the insiders at Crowdstrike are doing. You see that the CEO and president and the chief security officer are selling in the recent month, doing it at a price of 130, 135. See that Austin and Roxanne at the beginning of the year, she bought some at a price of below 100, so well done for her on that. But it's mostly selling. I mean, that the CEO is selling is not so strange if he has a position that's over 1.5 billion and he's selling for 1.5 million. So it's almost nothing. So I would also not look into that, but at least it's more selling than buying. Good to see that at least some gurus, hedge funds are building a position on them. So I'm going to give them 2 points for this. Because it's the total for the management culture of 20 points, which is not bad. They're mainly missing 8 points for the stock-based compensation. So hopefully in the future they can turn it around a little bit and stop with the ridiculous amount of stock-based compensation, because they're just diluting their shareholders. And if this trend of 150 million increase every year or year on year, then yeah, it just provides so much dilution. It's going to cost your performance as an investor. Then for the moat, First, the network effect and the product ecosystem. So for network effect, we already mentioned in the beginning of the video that they use something called a thread graph. So the thread graph is, as more data is collected, the thread graph gets smarter by the instant, providing visibility and real-time protection for all the customers. So they have billions and billions of threat incidents, which they then can immediately use to protect everybody who's using Crowdstrike even better. So that's a clear and very strong example of a network effect, and it's impossible for new entrants in the market to copy this, and also for competitors who are not that much focused on the endpoint securities, it's very difficult for them to duplicate this. So that's why I'm giving them 10 points for the network effect. Then for switching cost, well, if you already have not one, but you have 4, 5, 6, maybe even 7 modules already from Crowdstrike, and you have worked with their professional team, and it's completely integrated in your company, the switching costs are enormous. So I'm giving them 10 points for this mode as well. Also, actually, if you look at the net retention rate, you just see that people don't switch away from Crowdstrike. Then looking at durable cost advantage, I don't think they have any on the scale or physical location for the integration. I'm giving them 0 points for that. Then intangibles, license, trade secret, patent, or premium brand. I think only on the premium brand, I'm going to give them 5 points. I think Crowdstrike right now is one of the biggest names in the cybersecurity industry. If you also look at their clients and how many of the Russell 2000 and the major companies they have as clients, I think most of them also come to Crowdstrike because of their premium brand. So I'm giving them 5 points for that. Then looking at counter position, giving them 0 points for this. And cornet resource, the same as well. I'm giving them also 0 points. We get to the 25 points in total for the mode section, which is actually really good. I think it's more than most companies that I scored using my scorecard. So 25 for mode is impressive. Looking at the potential, the optionality of Crowdstrike. Now, as already also mentioned during the mission statement, so far they only focused on endpoint security. There's of course a lot of other ways that they can provide security in the cybersecurity industry. So there's definitely other ways for them to move into. Also, if you look at what they mentioned themselves in their investor presentation, that they want to increase their product offering. So that's definitely optionality. But it's also somewhat limited, so I'm giving them 4 points out of 6. Then for the risk section, the customer concentration. No client is providing for revenue bigger than 10% of the total revenue, so 0 points deducted here. Industry disruption, also 0 points deducted. And a binary event, so losing a patent protection or legal ruling, also not, so 0 points deducted here. You could look at different risk, like the risk of competitors. If you look at the biggest competitor of Crowdstrike, which is Microsoft, you see that Microsoft clients are changing from Microsoft away to Crowdstrike. And if you look at the total addressable market, so I also think that it's not really a winner-takes-all market, but there could definitely be multiple players dividing this market since it's going to be so big, and with probably several successful companies, then I don't see any risk on that. So no point deducted there. Which gives them 63 points and a score of 71, which is in my in-between score. So I don't prefer to invest in companies with a score below 70, or I don't invest in companies with a score below 70. I prefer to invest in companies with a score above 75. They have a stronger moat in general, they have better financials, the management culture is better. I do invest in companies that have a score between 70 and 75, but only when I think that they are able to increase the score in upcoming quarters or year. So if I look at Crowdstrike, where they lose the most points. So first on the return on invested capital, they already lose 16 points, because it's one of the most important metrics to me. During the discounted cash flow analysis, I have them as EBITDA positive in 2024, so then also be able to have a positive return on invested capital, and that would increase the score already a lot. For the management culture, they lose a lot of points on the stock-based compensation. I mentioned already a couple of times now about that the 550 plus million stock-based compensation is really killing your performance as an investor. So hopefully they can bring that down a little bit in the upcoming years and to at least more reasonable levels. And for the moat, they have 25 points, which is really a lot actually. They have a strong moat, and for that I really do like Crowdstrike. So now the final part, and I think for me always the most fun to play around with the numbers, the discounted cash flow analysis. So for this year, they reported their book year 2023. For me, that is 2022, just to have them more in line with other companies and to make it more logic for me. So for 2016, they had 53 million in revenue. In 2022, they had 2.24 billion in revenue, which is an average increase of 88.37% per year, which is really impressive. For this year, they already mentioned themselves in the conference call, they aim for an increase in revenue of 32 to 35%. I have them at 37. Crowdstrike usually under promises and over delivers, at least for the revenue growth. So I have them at 37. And for the law of large numbers, I have that number increasing the revenue growth year over year to 20% in 2032. I think the revenue growth that I have is still quite aggressive, but I think it's fair. I think this is something, but also with the increasing TAM and with communications from management before, I think this is reasonable revenue growth. And if we have a quick look at the revenue growth projections by the market, they have a revenue of 6.45 billion by the end of January in 2027. So for me, that will be of the full year 26. So if you look at full year 26, I have that as 6.237 billion. So my projections are a little bit lower than what the market is expecting. But I like to be conservative. It's good to have a margin of safety before your margin of safety. The average gross profit margin is 63.69%. In the last couple of years, the gross profit margin has been around 73%. Also for this year, I have it as 73%, and it's slowly increasing to 76.32%, which gives it a gross profit of 15.3 billion by the year 2032. The selling, the general administrative and marketing costs have been, as a percentage of the revenue, slowly decreasing. So in 2016, it was a lot more than the total revenue cost. Last year, it was 54% of the revenue and cost, and this is a trend that will continue. So slowly will continue to be as a percentage of the cost of the revenue. So for this year, I have it as 52.75% of the revenue, and it will decrease to 33.5% by the year 2032. The research and development cost have been around 24 to 27% in the last 4 years. And I think also this will continue this trend. So for this year, I have them as 24.5%, and I have them slowly decreasing to 23% of the revenue. I think it's also good that they continue to spend a lot of money on the research and development to make sure that their moat and their competitive advantage is staying there. So for the EBITDA, they still are EBITDA negative for the last 7 years. Also for this year, I still expect them to have a negative EBITDA of around 23 million. But then for 24, I have them as the first year as EBITDA positive, which is mentioned before would also be good for the return on invested capital numbers, which will become then positive. And have the EBITDA growing all the way to 4.678 billion by the year of 2032. Which is a nice EBITDA margin of 23.3%, so it's quite nice. The free cash flow has been positive for the last 4 years. I use it as a free cash flow percentage of the gross profit, which has been around 43% of the last couple of years. So also what I continue for the next years, a free cash flow percentage of 43% of the gross profit. We gives it a cash flow for this year of 964 million, which will go to 6.58 billion by the year 2032. The shares outstanding is increasing a lot over the last couple of years. Now, in 2020, here at least, related to the IPO, that they increased a lot, but also in the last couple of years, it's still increasing. And recently they mentioned in their earnings call that the shares will increase to 243 million, which is still an increase of 4.25% for this year. I have that number slowly decreasing, but it still will give a total amount of shares of 370 million by the year of 2032. The cash is growing with 12% per year. The debt is growing by 1% per year. We give for the cash of 7.6 billion by the year 2032, and the debt is increasing to 866 million. I mean, I still think that they can easily pay off the debt, and I understand that they haven't done that for the last couple of years because of the low interest rates. But let's see with the current interest rates if they decide to pay off the debt. But for now, I have them at increasing with 1%. The return on invested equity and the return on invested capital, they are both negative. Here you have the enterprise value calculation and the enterprise value by EBITDA, which of course is negative for the last couple of years since the IPO. That's why I also have the enterprise value by revenue, an average of 34.5, but to be honest, that number is all over the place. It has been as high as 54.4 to 11.3 last year. So for the total value multiple, it's a little bit difficult also to argue which number to pick for this one. If you look at other companies in the cybersecurity industry that are growing a little bit similar to Crowdstrike, or maybe not even that fast, but also grow quick, they have a multiple of 30. So I think also for now for Crowdstrike, a multiple of 30 is quite fair, but not sure if 10 years from now that multiple is still valid. So let's do both of them, a multiple of 30 and a multiple of 25. I mean, up to you to argue which one you think it's more reasonable in this situation. For the discount rate, I have 11.94%. This is a combination of the 10-year UST bill, the beta adjusted equity, size premium, and specific company risk, which gives it 11.94% as a discount rate. With a multiple of 30, that gives a share price of 463.9 by the year 2032. If you use a margin of safety of 25%, it gives a buy price of 131.16. And currently I have here a price of, let's say, 130, which means that Crowdstrike is currently undervalued at 0.8%, which basically means that the current price is a fair value of what Crowdstrike is representing right now, at least with the multiple of 30. If you use the multiple of 25, it gives a buy price with a margin of safety of 115.16, which means that currently Crowdstrike will be overpriced by 11.5%. But this is my assumptions. So feel free to make any changes, and you could argue that the revenue growth could be a lot higher, with the increasing TAM and also with the growth that Crowdstrike has shown in the past. You could argue that the cost would get lower, although I don't think that's really reasonable to lower the cost for the research and development. So all in all, I think the current price of 130 is quite fair. This brings us to the end of this video. I hope you enjoyed watching it or learned a thing or two about Crowdstrike. If you could do me a favor, please subscribe to my channel or at least like this video. Going forward, I will try to release a new video once every 2 weeks, so it will show up at your timeline immediately. And for now, thank you for watching and goodbye.